Hey everyone, this is Rahul with the Alternative Investors Hangout, and today I have a new guest, and he is Norman Greene, aka Argentus Maximus, and he's on TF Metals Report. He runs a blog there, and he also has his own subscription letter, and it is the Rhythm and Price, and it's actually a really interesting subscription, and I've watched some of his videos, which I find fascinating. Since I'm not an expert in technical analysis, he is, or he does know quite a bit about technical analysis. And we have here Norman. Thanks for coming on.
Hello, Rahul. Nice to be here.
Thanks. All right, so when it comes to gold and silver, I was looking at some of your videos, and you were thinking that we could potentially be close to the bottom, or we could be at a point where it could be trading sideways, it could potentially go up for a little bit, then go down, and then we could see the ultimate bottom. How do you see silver right now? And I mean, right now, it's, I think, 40 cents up over Christmas Eve.
Silver is probably going to trace something that looks like a letter Z turned on its side over the Christmas period. Right on Christmas Eve, we were rallying to the top of the last 3 days trading range. And as the volume is low, I would expect that, the main dealers and algos are switched off, but there are still professionals in the market. And there is no way, having gone for the top of the trading range, that they shouldn't run it to the bottom of the trading range on something or no news. And, so I would expect some sort of little sharp pull down before the volume returns to the market, and then we kind of start looking for the next main direction. Looking into January, well, we're at the bottom of the trading range, but silver is sitting on a break point. That is to say, it's sitting on the more or less on the late June, early July lows. And the break point, of course, is does silver rebound or does it penetrate? Now, it has in some currencies it has already penetrated to new lows. Anyone who's looking at silver or gold in euro, those lows have been taken out. If you choose to look beyond the dollar, you start to get a different viewpoint as to the relative strength of these. I'll go on balance for the rally right now, but I'm not saying that is a bull market. I'm looking for an upswing to the upper side of our trading range, and then we have to go down and double check the bottom before we establish that was a bottom. The market very rarely does anything in a V top or a V bottom. Stock markets at the moment are probing highs. They're not going to collapse without probing highs a second time and failing to get through, or getting through to an infinitesimally small amount. And it is the same. Now, in the metals, we can actually be a little bit more bullish because the metals have been down here in midsummer last year. I'll call it last year because we're about to turn over into 2014 within a few days. And we are back there again. And if the metals fail to significantly get down into new lows in any given currency, then that is visible, that is painted on the charts, people can see that. The momentum traders, the algorithms, all of them readjust their odds in the light of that. They all have to take the view, it's harder to get it down than it was. And it would make a significant difference to the power of expected selling. Now, I fully expect silver to come back down. If we get the rally I'm looking for, it can take us, let's say, around 5 to 10 weeks. But if I take a quarterly view of the chart, that I'm not going to look at every little tiny tick on a futures chart, I could see us kind of taking it up into April area with a big sell-off in January, February. I expect sell-offs to be very proximate to highs in the next 6 months, which is to say, if I say I'm expecting a low in, say, May, I might be expecting a new high only 2 weeks before that. The cliff edge phenomenon, I believe, is moving from the front end of the trading ranges towards the trailing end of the trading ranges, and that to me is a sign of getting closer to a bottom. Which is to say, the confidence of sellers to sell is only reaching critical mass when the market has traded sideways and got closer proximity to those downtrend lines underneath which it's encapsulated. Before this, they were willing to sell in the middle of a trading range, on any news, on any non-news. I mean, the joke was that every time Der Bernanke opened his mouth, gold sold off. Check it out now. They're not doing that anymore.
Because Bernanke's gone.
Well, yeah. But, he's gone. He's sloped off into the background all right, hasn't he? Did he do a wonderful job or did he do a pathetic job? Kind of depends on which side of the fence you are, doesn't it? Anyway, I'll leave it at that.
All right, and for those listening at home, just make sure to understand this is just our own opinions, and don't trade based on this. Always seek a financial advisor or do your own diligence. I just had to point that out. But going to what you're saying about how gold and silver have been underperforming and the stocks have been going up, I'm looking at this chart that you have on TF Metals, and you have an interesting chart. There was a gold top in 2011, and the bond market, it seemed like it was topping out in late 2012, around that range. And if you look at that, there was then a handoff from the bond market to the stock market, even though the stock market was continuing to go up. And it just seems, based on the way that the charts are going, that the next handoff in the cycle is most likely going to be from stocks to gold, silver, and then maybe some of the natural resources.
Yeah, I think I'd go along with that. In the big picture, it's the natural way of thing. People say that the business cycle has been done away with all QE. But in actual fact, all that has happened was a longer-term cycle was put on pause. The business cycle, which has always been mysterious and yet is in everyone's face, is still there. And in that article in TFM More, and with that chart, Rahul, what I was doing was, maybe we'll give a link at the end or something in the narrative to this so people can find that article, or if I give free access to it on my blog or whatever. But I was showing that the natural order of the business cycle is for bond market to peak, followed by stock market to peak, followed by the commodities to peak. And essentially, and then it goes back to bonds. And what we're looking at there is the capital which does not leave the economy, and there's a lot of it. The capital which leaves the economy flees the economy and disappears via a currency carry trade off into another economy where it tries to find yield in someone else's bonds. But when the when the economy is beginning to rise, there are greater capital gains to be got by switching markets within the economy than there is by zooming to another economy where bond yields might be just like 0.25% higher. So the carry trade is a phenomenon of searching for yield, and it represents the fact that the market was frozen in the bond phase of the business cycle. Now, the bond phase of the business cycle can basically be described as the depression phase, because when the economy goes down, interest rates naturally fall as demand for capital reduces. And as interest rates are falling, the bond market gets a great advantage. It attracts capital. And that is exactly the same time that the government wants to start overspending to try and provoke some sort of recovery. So the government exploits that attractive bond market by selling more paper, taking in more cash, and putting it into their various projects, of which there are a plethora in every country in the West at the moment, and Japan. If I say the West, Rahul, please, I'm talking about English-speaking plus Japan at the moment. It would be Canada, US, ECB, Bank of England, and Bank of Japan, all of which are acting in concert, have been for the last 5 to 10 years, and are certainly locked into that little arrangement for the next 5 to 10 years. But in the circumstances, the money gets attracted into bonds, the yields fall, and everyone says yields can never go below zero, and they've gone very low indeed. But I assure you, yields can go below zero. In the 1970s, in a strong market economy, in a strong currency economy of hard currency, that is exactly what happens. The Swiss, for instance, had to go to negative yields to stop their currency going sky high. Now, this time they've locked it to the euro, but we're kind of getting close there. The Japanese have cracked down their interest rates into negative territory. At the moment, interest rates in real terms, in inflation-adjusted terms, are negative. It remains to be seen if Janet Yellen will push them physically and nominally negative, which, of course, negative interest rates, of course, throw the money industry, the fund industry, onto the bus. There is no reason for a money fund if interest rates are negative in nominal terms. But they don't want to do that. They'd rather have inflation cracking along at 2 to 4% above interest rates and thereby make their money that way. So what happens when the economy bottoms is, let's say, early signs of growth, and I do not mean the political term, green shoots. Early signs of growth are detected in early cyclical stocks. And money flows into the stock market. Now, first of all, it goes looking for yield, and it goes into, let's say, the large caps, the dividend-paying stocks, the Exxons, the Coca-Colas. When you get down to it, those stocks actually resemble bonds. They are extremely long-duration companies. They have extremely low risk, and they have a very long history of either dividends or dividends which are increasing over time. So, what could be better than, a stock which becomes, in effect, an inflation-adjusted bond? But after that, the return will actually come from more volatile stocks. And the money, when those large caps have absorbed a lot of capital, the bond market is starting to top. The early stocks are beginning to look lively, and capital looks for the next best thing. And that'll be the cyclical stocks. Now, we've already passed that phase. You find that the ags, the food, the stocks which are related to related to hard assets and important things to life, classically food. And then slowly what happens is those stocks rise and the capital looks for the next best thing, and then it begins to roll over. And once again what you see capital rotating into the next level. The next level is kind of where we are now, where we're kind of at it. It's after the cyclicals, it's what they call the growth stocks, but all within the stock market. And slowly but surely the capital rolls out of those into the high flyers, the stories, the fashions. And when that happens, you're already hitting the papers because the market has hit new highs, like we are now, and the inflation is arriving. Now, when the stock market begins to fall, two things happen. One is the people who have made fast money start losing it. But the people who made money more methodically, they're already halfway through the outdoor. And they're looking for the next best thing, and they're already trading the most undervalued inflation asset there is, which is commodities. So as the stock market starts to zoom into its overbought territory in terms of the high flyers and the big stories, people are leaving the old money, the big money, which might have pumped those at a very early stage. It certainly doesn't hang around in them. It's already moving into commodities. Now, the commodities demonstrate that the inflation is actually here. The Fed pulls the rug. Liquidity is pulled. Easy money disappears, and the banking system starts to work in reverse as interest rates rise, and also maybe lending restrictions are put on. And of course, when you reduce the amount of money that's available, all sorts of things happen. But classically, people who have borrowed money to buy things have to repay their loans because the expected return is going to be lower than the expected interest rate. And as they do that, the stock market dies, the inflation assets peak, and already the market is already anticipating the next recession, and capital is already at the early side rolling into bonds to catch the interest rate fall. And at the late side, of course, it's the people getting demolished in the last ones out the door in inflation assets such as, commodities. Now, gold and silver would, in my book, be considered leading edge or front edge commodity assets. That is to say, they are very good at anticipating the inflation phase. So they can be rising while stocks are still going up. They bottom early, and they will top long before the commodities top. Usually I expect it that way. Now, the chart I showed you was actually showing that of late, it seems that there seems to be about a year delay between these items. Well, think about it, Rahul. If you have bonds to stocks and it takes a year, and you have stocks to commodities and that takes a year, and commodities to bonds and that takes a year, now let's just round off the 6 months to a year that sort of gets lost in the edges and say, isn't that a 3 to 4 year business cycle?
Yeah, you could say that.
So the whole thrust of that article was to remind people who are getting very demoralized in precious metals, which are hitting lows, that precious metals have A, not been hitting new lows in every currency, and precious metals are B, hitting lows at a time when stocks are hitting highs. And that is usually a sign, we're kind of coming to the next phase. So I would expect to see the stock market sell off and money roll out of the growth stocks into the wacky stocks, and at the same time other money roll out of the growth stocks into that which is basing and cheap, which is precious metals, and also the other following commodities. And it's very interesting to note at the moment that copper doesn't seem to be going down the way it was before. Once again, the basis in these metals is not exactly completed. It's not exactly clear. If you look at it on a chart, you can't say, oh, there's the bottom there. And they're certainly not going up. But they have come to the point where they're not really going down either. Somebody's buying them. So I think that's where we are in the whole big picture. I do believe Yellen is going to see the inflation phase and we'll actually see the stock market high. I think we'll see that within the next 12 months. But I'm not one of the ones that's sort of saying it's all going to collapse tomorrow. The business cycle is it's such a calm affair, that if you stand back and just drop the leverage for a minute, there was an old phrase that was said to me once by somebody. Said, he says, throw your chart on the floor and walk back to the other side of the room. Then look at it. And, distance provides a bit of perspective sometimes.
Right, and I was looking at one of the charts again on TF Metals Report while you're talking about how the stock market could see another high, and then if you want to look at the bond market, though, compare that to the stock market, I've noticed that it's really strange, or it just works out to the sense that when the bond market bottoms, there's a stock market peak, and I could see this from like 1990, and then you see another similar event in 2000, and then in addition you see something like this in 2008, 2009, and it just looks like, based on that fact, you could see something like that happen in the next year, 6 to 9 months, where you could see, or is it going to be different this time?
It's always different and it's always the same. Yes, it's going to be different this time because anyone who tries to trade it on the basis of how it went before will be wrong-footed. But you are correct. At the same time, you are correct. In the broad thrust, it is interesting to see the bond market making bottoms at the same time as the stock market makes highs. And that is indicative of the fact that markets tend to fall faster than they rise. So the bond market makes its peak, and then it hands over as the capital moves over to stocks. And the bond market falls very fast, and it somehow makes its bottom around the stock market making its highs. But there are two subtleties I would mention which are characteristic of this. And the first is, it ain't so simple. And I'll identify the difficulties. The bond market in the long haul tends to make about 3 significant highs for every high that matters to capital rolling over in the business cycle. Is that a way of saying the bond market makes triple tops in the classical technical analysis sense? No, I don't really mean that. But the fact is, the bond markets are going up. Let's say they're trending up, and you got this classic saw edge blade rising from bottom left to top right on your chart. Well, there tends to be 3 big ones, 3 big highs, and somehow one of them turns out to be the one. And it's not always so, and it's always as always. The historical ones are dead easy, but it's the one on the right-hand side of the chart that you can't see the other part of. That's the hard one. But when you look back, you find there tends to be, a few false alarms, and then they recover. So I do believe that what you're looking at there is capital rotating through different classes of bonds. Now, the Elliott wave people would say, oh, there's 3 waves up, wave 1 up, wave 2 down, wave 3 up, wave 4 down, and wave 5 up. Well, if that means there are 3 swings and 3 highs on the way to the final high, yeah, I'll go along with that. Because the early bonds would be rolled off. I consider different qualities of bonds. I mean, there are going to be sovereign bonds which are considered very safe but have a low yield. Well, when we're in a depression, maybe that's what people want, safety. But as soon as things, as even competition gets going for those sovereign bonds, they get overvalued. And all of a sudden they're more risky and less yieldy than people want. And people start looking at things like municipal bonds or corporate bonds. So the bond market, it has this rotation from different types of bonds, which makes it resemble the stock market, where people get going in dividend high caps, roll over into growth, and roll from there into high flyers. It's funny how similar it is in that sense. Now, the coincidence of the stock market bottom the bond market bottom with the stock market top. It's a very brief phenomenon, Rahul. When you go back through the past 50 years or so, you'll find that bond market bottom is a very brief bottom. That nearly always there's a bounce almost immediately after it. So the stock market starts going down, and it's amazing. It's as if the bond market just takes a sudden dose of capital fleeing into it, almost like people running to cash. A certain percentage of people run to bonds. Bonds shoot up, and then bonds come back down again, and they make a second low. Well, okay, if the stock market's making highs and the economy is doing well or beginning to then classically the stock market top is going to be when people begin to perceive it doing well. I mean, it's the removal of doubt, isn't it, that makes the high. People who were doubtful say, I'm no longer doubtful, I'll buy. That's the high. So the removal of doubt of a better economy paints the stock market high as people purchase stocks, probably the last ones, and that becomes a stock market top. But at the same time, the bonds which were being neglected, they get a bit of that rotation that's going to go over towards commodities. Now let's just consider, during the previous recession, the market was all about bonds. And then it went into stocks, but people still have this, they've been trained to regard bonds as safe cash. So when the stock market tops, what happens is the capital flees from stocks, and it flees towards what I will call money. Now money can be cash, money can be bonds, or money can be gold. And at different times, different things are considered cash. In a wartime, people have learned gold is money. In peacetime, people go, what's gold? It's no use. I prefer have dollar notes or euro notes in my pocket. That's cash. And yet, when you get a sovereign and they go and they find themselves suddenly the owner of, $100 million or something, they don't want dollar bills. They don't want anything like that. What they want is a piece of paper that says this is a bond from the US government worth $100 million. So, bonds can be cash. Now, after the stock market makes its high, I think what happens is capital splits. Some of it goes backwards towards bonds, reevaluates, and then goes towards commodities, and you get the bond bounce, which is short-lived. Some of it goes towards gold, and the gold bottom is in. And then the commodities are beginning to bottom, as some of it goes towards commodities. After all, it's inflation times are here again. But then, of course, the gold, which reacts very fast, will have done its job at some point, and the money will flow out of gold, which is non-yielding, into commodities, which may have some sort of growth in their value, which is not present in gold. Negotiability, other things, all claim their place. But to say simply that the bond market bottoms as stock market tops might be true, but boy oh boy, you'd want to be fairly fast at catching that bottom. Does that cover the angle you had in mind?
Yeah, these are some decent topics. I think we're running out of time right now. I usually keep interviews like under 25 minutes or around that range, and we're at that point. But anyways, Norman, before I let you go, how can people follow your work?
If people, I have a blog which is once a week on TFM or tfmetalsreport.com. I'm a guest contributor there. I keep the daily thread in the gold section of their forum, which is the setup for the big trade. It's pretty much a daily contribution on precious metals, which would represent a single stream of what I do in research. I'm not just a researcher or an analyst. I'm a trader analyst. So anything I talk about, I will be doing about it with my own capital too. So I do have a vested interest in all the things I say, but I'm not so facetious as to think that my tiny positions will move the market or to try and influence so many people that they would move it for me. We're talking small beer. But I would declare that. And my own website is, it's about to move domain, but at the moment if you Google or do a search for Rhythm and Price, as in RHYTHMN Price, or even Argentus, Maximus or Norman Greene, all of those will pull up my website, and they'll find the link, of course, in my signature on TF Metals Report too. I do a newsletter which is about every second day or 2 out of every 3 days. It goes by video to subscribers, but there is quite a lot of stuff which turns up on my website, which is maybe variations on the freely available material I put on TF Metals Report. And there are lots of articles which might be of interest. The emphasis is on cyclical stuff, on sequences. So timing the market, I regard it as extremely important. And certainly I regard it as less manipulable by the powers that be than pricing. So, I mean, let's say prices are being depressed in metals at the moment by those in politics. Well, you can say to yourself, I'll watch the price, but they might always shove it another tick down and take you out. But if you say, I'll wait until they run out of money, well, it's a little bit harder for them to fade your game when you do it that way. So I have regarded timing as being far more important and far more reliable. And the application of technical analysis tends to be, in my book, after I've got the timing right. So I say, I think I've found the bottom. I think I've found when it's about to turn. The guys who are selling are about to run out of cash. Now, what do I see with technical analysis that now enables me to capitalize on that knowledge? So I'm using cycles and technical analysis. It's entirely chart-based or data-based. But of course those cycles, every single cycle represents somebody real out there doing something real, whether it's the President of the United States or Japan pumping the economy like mad before election year or withholding cash after the election. You know, the presidential cycle is a 4-year event, and we've just maybe seen the bottom of that recently. But, you know, as I say, the cycles are like a bridge between fundamental analysis or rhythmic fundamentals. It's amazing how little fundamentals can actually penetrate through the news block. They just can't get into the news. Like, Company A makes a bad deal today. When does it come out? Their next quarterly report. A war breaks out in some country, or somebody shoots somebody or whatever somewhere in the Middle East. When do you hear about it? The next daily news report. There's in the news system and in the publications system, there are these periodic filters, and all the different fundamentals only get out at the next rollover of those cycles. So it's amazing how even random events become cyclical events by virtue of fact of time delay of the knowledge just caused by the system. So that's all boiled into what I do. When those 3 places are people, if people want to sort of sniff a flavour of it, they should find it in those. I hope you haven't gone too much over time, Rahul.
No, it's great. All right. Thanks for coming on again, Norman.
You're very welcome. Thank you.